So now we're going to look at exercise 1-29. So exercise 1-29 is on page 42 of your text. And in this one, we're looking at the accounting equation again, and we're looking at how transactions affect this accounting equation. All right. So we've already have it set up here. We have assets equals liabilities plus equity, and we've already listed everything that falls under assets. We have cash, medical supplies, and land included under here. And under liabilities, we have accounts payable. And under equity, we've got our capital account, withdrawals, service revenue, salaries expense, rent expense, and utilities expense. Okay. So these things, all the expenses reduce equity along with withdrawals, and then the capital account and service revenue increase our equity. Okay. So these transactions they give us are for Karen Smith, and it says they opened a medical practice during July. The first month of operations, the business gave Karen Smith, let's see, she experienced the following events. So on July 6th, she contributed $55,000 in the business by opening a bank account in the name of C. Smith, MD, and the business gave capital to Smith. So here we're having an increase in our capital. Okay, so we're increasing cash by $55,000. All right. So we got $55,000 that's going in our bank account. So that's, of course, increasing our cash. In exchange for that, they're going to give